Welcome to the CDFA Hotline. My name is Kristen Sharon, and I'm very glad that you're joining us today. On the CDFA Hotline, we bring real questions from the public into conversations with professionals who work in divorce and financial planning. Our goal is to help you better understand the financial side of divorce and to show you how certified divorce financial analyst professionals can help make people informed, thoughtful decisions during an incredibly emotional time. One of the things that we hear constantly from the public is, I read online that. And while the internet can be a great starting point, it can also be incredibly misleading, especially when it comes to divorce. Divorce finances are heavily influenced by state specific rules and advice that may be accurate in one state and may be completely wrong in another. What works in California may not in Texas, and what someone experiences in New York may have no relevance elsewhere. So today's episode is designed to help you understand why that matters. I am joined by three exceptional certified divorce financial analysts today, each practicing in a different state. I have Donna Lascala, who works exclusively on divorce cases in New York, Lori Eichen, who also is known as the Options Lady, who has deep experience in California, and Pam Friedman, who focuses on divorce financial planning and divorce analysis in Texas. So thank you so much, ladies, for joining us today. I'm excited to have you.
Thanks for having us.
All right,
Thank you.
together we are going to walk through some of the most common assumptions that people make after reading divorce online. And we're going to show how those different assumptions can play out depending on where you live. Before we begin, I just want to share an important reminder. The purpose of this show is educational. We'll be discussing divorce-related financial topics in a general way to help listeners better understand concepts, planning considerations, and resources. We cannot and will not provide personalized legal, tax, or financial advice. Every divorce situation is unique, and outcomes depend on individual facts, professional guidance, and state-specific rules. So nothing you hear on the show should be construed as legal advice, financial advice, or tax advice, or a substitute for working with qualified professionals in your state. Our hope is to help you become more informed consumer and to point you in the right direction. All right, well, let's dive into it. From a financial planning perspective, how does property division thinking differ in your state? And where do most people misunderstand it the most? Donna, do you want to get started in New York? How do you help your clients financially plan when outcomes are not automatically equal?
Sure. So I think one of the biggest things that trips people up is this idea of 50-50, equitable, equal, and what all those things mean. And it is very state specific. So one of the things that we really try to explain to clients, especially in New York, is that yes, we are an equitable distribution state, but different assets are handled differently. The house is handled differently from the retirement plan, is handled differently from stock options, is handled differently from regular brokerage accounts, savings accounts, cash. And really, the first step in that process is to determine what is actually marital versus what is separate property. Because that's a really good starting point for everyone. You can't just say, okay, here's everything that's on the table right now that we've accumulated in these last, 10, 15, 30 years of marriage, and it's all going to be split 50-50 because it's not actually the way it happens, even in an equitable distribution state. So what do I mean by separate versus marital? So a lot of times, especially with people who have gotten married later on in life, they've worked for a considerable amount of time prior to getting married, or they've acquired property, whether they bought a condo and then it became, they took that and then turned it into a house, or, whatever the case may be, they've acquired assets. So the first thing we really have to figure out is that a marital property or is it a separate property? Things get a little complicated when things get commingled. And as we all know, when you get married, unless you've got a prenup, you're not really thinking about, well, what happens to all the stuff that I bring into the marriage with me? Am I sharing everything with my spouse? Well, I love you, you love me, we're going to share everything and we're going to be happy. And you don't think about the potential consequences of what if the time comes when we're no longer I love you, you love me, and we're happy. And now we have to split everything. So deciding, understanding, figuring out, determining what really is in the marital pot is the first step to helping people understand how things are then going to be separated. And if is it 50-50 or is it not, and why?
Right, Lori, you're from California, and California is a community property state. So financially, what do people assume that means, and where do their assumptions fall apart?
Thanks for having us, Kristen. Just as Donna said, the first analysis, even in California, although she's in New York, is understanding the difference between community and separate property. And this is why it's so important to work with a CDFA who is well versed in your state, who gets educated on the laws, the statutes, the code, the case law. We are not attorneys, but in order for us to do our job, if we don't understand the laws, we are going to give you wrong answers. So let me give you an example. In California, if the parties cannot come to an agreement, community property will be divided 50-50. So the question is, just as Donna talked about, what is marital property, which is also called community property in California, and what is separate property? I just am working on a case right now as a neutral. These people have been married 18 years with a child. And once I got through explaining to them how much separate property husband had, I just did a separate property tracing on his SEP IRA. And I looked at all the contributions during the marriage and all the withdrawals during the marriage because he's 20 years older than she is. That thing is worth 1.4 million. She is going to end up with only $15,000. And she's looking at thinking the assumption that everyone makes, $1.4 million retirement account. We've been married almost 20 years. I get half. And it doesn't stop there. The home, she was never put on title on the home. And while we have case law in California that gives the community credit for principal pay down of a mortgage during the marriage or capital improvements, and also in Latin, a pro tanto share of the appreciation, those numbers are going to be eye-opening. So the bottom line is that we all know gray divorce. People are getting married later in life, and they're also coming to you as a CDFA when it's their second or third marriage. You've got to separate out community property from separate property and make sure both parties are educated so expectations are level.
Thank you for explaining that. And Pam, tell us how this differs from New York and California and Texas. So when people have these misconceptions from the information that they read online, help us understand how that impacts financial planning in Texas.
I would reiterate all the points that I've made before. Oftentimes, people are surprised by separate property being as large as it is, especially in large marriages, and something we look out for. But I'll take a little bit different tact is that you can't split what you don't already see. And so getting everything on paper first, knowing what's there, and then knowing where the questions are about separate property is also critical to even starting the process. So clients often jump to, well, I'm not going to get this, or my husband will never let me have this, or my wife doesn't even know about this, something like that. We need to be seeing every single financial asset and, real property asset, like a house or rental property. We need to see all of that, know what's there, to ask the right questions to make sure we understand what's there. So there are fewer surprises. And I would point out that you want an experienced CDFA working with you who does know the law, but we also as CDFAs do not tell clients this is absolutely separate property. That is a legal concept. And so I'll point out to the listeners that for many things that we're going to talk about today, they sound like financial issues, but they're actually legal issues. And we're always working with attorneys and experienced legal professionals to get a final answer and help people make decisions.
Thank you so much for explaining that because I think it's a really confusing concept that it is, like you said, a legal conclusion. And what we can do as CDFAs is we can trace the property to help you make those arguments, but we don't make those legal arguments for you. We provide the data so that the legal arguments can be made.
And when on top of that, when I'm serving as a neutral, maybe two attorneys, each person's the attorney and they've hired me as a neutral, or the parties are in mediation, I often find myself running calculations several ways because I don't know which case law is going to apply, and it's not my decision to make. But as CDFAs, we can provide different scenarios, which I think is really beneficial, especially when parties want to know, well, how far off are we if I take this position, this position? Maybe it's immaterial and it doesn't matter really.
Mhm. Um, a lot of people read online that support is based on income and they assume that it's just a simple formula. From a CDFA perspective, how does income complexity, things like bonuses, commissions, stock compensation, self employment, how does that change the financial analysis in your state? Lori, we can just go ahead and stay with you.
Oh boy. Okay. So I'll try to be brief if that's even possible. But child support and spousal support in California are treated very differently. And although we can come up with what we call guideline child support calculations and temporary spousal support calculations, a judge must follow a dozen statutory factors when setting what we call long-term support or permanent support. But let's get into the income side because we're really the ones doing the data. I specialize in equity compensation, and that means that one or both of the spouses are getting restricted stock units or stock options or different warrants. There's all different types of animals of this equity compensation. And what I try to do is I try to make sure that there's no double dipping, meaning that in the analysis, I am using our case law to allocate what of this compensation that was granted during the marriage, but vests after the date of separation. The date of separation is pivotal in my state. The date of divorce may be pivotal in another state. So I have to calculate the grants that were made prior to the date of separation, but vest after the date of separation, or sometimes the grants made prior to marriage, but vest during marriage. What is community property to be divided? Usually we look at the net number after estimated taxes are withheld. But for support, child and spousal, we are looking at the gross value before taxes on the compensation. And depending on how your child and or spousal support order is based, we may be using something called a Smith-Ostler or Ostler-Smith bonus table, where we're applying a percentage to any income earned above base salary. As you can imagine, this isn't rocket science, but it's incredibly confusing. Details matter. And I can't tell you how many folks get this wrong. And here's again an example why an experienced CDFA can really add a lot of value so that it's done correctly.
Donna, tell us a little bit about how this is consistent or inconsistent with how things work in New York.
The way things work in New York, as far as income for things like child support and spousal support, is that we have caps. We have legally determined income caps that are used. And by the way, they're different for spousal support versus child support. So if we're going to pierce the cap, which is the phraseology that we use in New York, if we're going to pierce the cap, there's a very high earning couple and they have maintained a specific type of lifestyle based on an income that's well above the cap. We have to look at 14 different factors in order to substantiate why this is happening. Why are we piercing the cap? But generally speaking, it starts with that cap on income from the standpoint of the calculation for child support versus the calculation for spousal support. Now, again, like Lori was saying, I will agree that things like deferred compensation make it a lot more complicated. And where we sort of start with some of those calculations is this compensation normal, regular, consistent? Is it in your employment contract? Is it expected? And also looking at the thing that Lori brought up of double dipping. Have you actually received these stock options? Have you exercised these restricted stock units? Are they now sitting in a brokerage account? Or are we going to be sharing them as part of equitable distribution? So then they're really not income anymore because they're already in another place and they're going to be handled in another way. We also do look at some calculations as far as grant date, vest date, separation date. We do the coverture fraction, which is a way of figuring out what actually of this is marital. Because again, with RSUs or stock options, it's when it's been given to you, it's when you can actually take the thing and turn it into a stock and then realize the benefit of this. It's kind of like phantom income until it realizes itself into something actual. Then you sort of look at it. We also do a lot of lifestyle analysis, looking at that piercing of the cap for purposes of what is income, explaining to people what's actual income, what's not actual income, what is normal. Bonuses may not be guaranteed. It may be just the possibility that. So, there's a lot of conversation around what is actual income, what's being used to do this calculation. And again, starting with that, well, this is the cap, and it does change pretty consistently. Right now, it's, $218,000 for spousal support is the cap, and 187 is the cap for child support. And then there are, subsets of all of that. So it's a pretty complicated thing. You can't just say, okay, well, this is the income and this is what I'm getting, because there are so many other things that have to be addressed before you determine. So yeah, working with the CDFA is key there, because we can explain all of those things and how they pertain to your particular situation.
Pam, tell us about Texas and how Texas might handle lifestyle analysis differently than Donna might handle it in a case in New York.
Well, we are the Wild West after all, at least the Southwest. There is such a thing as alimony. People do hear on the internet there's no alimony in Texas. There is such a thing, but there are requirements to receive it are quite dire. Someone's disabled, very long marriage. There's a lot of requirements. And even then, it's limited to right now, I think $5,000. And it would be over for a very limited time period. That doesn't mean we can't get some form of future income other than just what's on the assets and dividing the assets and the bank accounts and all, the house and all those other things. There's typically a need versus ability to pay. And so if we have a spouse who hasn't been working for several years, needs some training, uh, if the marriage is longer than 20 years, it's likely that there will be some type of alimony, which might be contractual, which has its own advantages and disadvantages. If the spouse that's paying loses his income, he may still be required to pay that contractual alimony under contract law. So don't think of Texas as just, I'm never going to get alimony. There are ways to negotiate a need, especially when there needs to be some retraining or just a gap in someone's income for the first, I would say, 5 to 7 years after marriage. There are even cases where people are very generous and they want to put it in a contract, and they want to make sure that their spouse, maintains their lifestyle. In mediation, you can agree to whatever kind of contract you want to agree to as long as both spouses agree. So don't give up just because you're hearing on the internet there's no alimony in Texas.
Good to know. All right. So one of the most common things people say is, I just want to keep the house. Why is that one of the most dangerous assumptions people make after reading divorce online? And what is it important that you want everyone to know about your state? So, Lori, in California, appreciation, refinancing, property taxes really complicate this decision. How do you help clients think through this in California?
Oh boy. As we all know, California is one of the most expensive places to live. So it's not uncommon that I'm working with couples where there has been so much appreciation in the value of the home. So some of the basics is that, again, first of all, we have to see if there's any separate property, and we have tons of cases that some conflict, overlap. It's very difficult to even establish sometimes what is the community property value, but let's just say it is all community property. Then the spouse wanting to keep the home has to figure out, how are they going to buy their other spouse out? Are they going to, refinance the mortgage? Are they going to take a second mortgage? Are they going to give up retirement accounts? I think among all states, you'll see CDFA professionals having very similar discussions with their clients. So the number one is, are there even other assets in the marriage to buy the other spouse out, or are you going to take on more debt to do it? Number two, in a parallel process, you have to be looking at, what are the real carrying costs of the house? We all know as CDFAs that every single homeowner underestimates how much it costs to live in that house. People don't think about maintenance and repairs. Okay. So first of all, are there even enough assets to buy your other spouse out? And number two, is there even going to be enough income to afford? And then you have to look at, can you co-own the house short term, perhaps to get Johnny through high school, and then you do a deferred sale? So the house is the number one issue I think many of us face in our divorce cases. And it's so difficult because emotions run wild on this issue. It is simply not simply a numbers game, because there's emotions, and emotions have a price.
Donna, things are certainly not any less expensive in New York. Tell us about how housing costs impact your financial analysis in New York.
So, as far as New York is concerned, we're still kind of reeling from the whole migration from the city out to the island. So there was a whole redistribution of humankind that started, back in COVID. And we're still kind of dealing with that because interest rates were very low and people locked into mortgages at 2.5%, 3% on homes that they paid way more money for than they should have. And now they're being faced with some issues that they don't always have to deal with when they're going through a divorce, which is I don't want to give up my 2.5% mortgage to have to refinance this house to buy my spouse out. So the conversations have become a little bit more difficult. The other thing that we're really dealing with, getting back to the huge migration of humankind, is inventory. So if we're in a neighborhood and I want to stay in that neighborhood because I have kids under the age of 18 and I want them to be able to finish out their schooling, but I can't afford to keep this particular 5-6 bedroom house, I want to downsize. Where am I going? Where am I going to be able to go? What am I going to be able to afford? Prices are still inflated and now interest rates are higher. So the conversation about the marital home becomes a lot more complex and complicated when you're not only dealing with a high rent district, but you're also dealing with the situation of the real estate market in and of itself, high interest rates and high prices and low inventory. So trying to, as Lori said, think outside the box. Do we co-own? Do we do something different? Is this a deferred sale? Are we using other assets to offset? But then you have to get into the conversation of, okay, so you'll keep the 401k and you'll keep the house, but those two things are not equal. The tax ramifications on those two things are not the same. And if someone's telling you, well, this is worth 500 and that's worth 500, they're wrong, because there's so much more to that than just the bottom line number. So that's where our expertise as CDFAs really comes into play, because we can talk to them about alternatives. Are there other ways to do this thing that you want to do? And also, again, as Lori said, there absolutely is a price on these emotions, because we're dealing with people's homes, not just their houses. And that really comes into play. What price is your emotional capital here? And do you want to think about a short-term time horizon versus a long-term time horizon? Are your kids 16 or are they 6? How much longer are you going to be holding on to this until it really doesn't make any financial sense anymore? So there's all of those what ifs that we can help run through. And I always say, look, if you do A, B, and C, then 1, 2, and 3 are going to happen. But if you do C, D, and E, then X, Y, and Z are going to happen. And do all those things go together? Maybe, maybe not. You can pick and choose, but you have to find the right mix of what's going to work for you in your particular situation.
I think you guys are doing a very, very good job of explaining why you can't believe everything that you read on the internet. Pam, we're just about out of time, but I'm going to finish up with you today. If someone was listening, and you wanted them to remember just one thing before trusting reading anything that they would read online about divorce finances, what would you say to them?
Spend some time doing some research on the internet. That's great. But also spend an hour with a certified divorce financial analyst if your issues you think are going to be financial, but there will be assets to divide. Spend an hour, pay for it in both cases, likely, with an attorney and get their view on your divorce. That's usually a scarier step than talking to a CDFA, because CDFAs are financial planners. You're just seeing a financial planner, but you're considering divorce. Certainly, sitting down with an attorney starts to make everything seem a little more real. And I know that's scary, but to go into this without talking to an attorney doesn't make any sense. Spend an hour, get some consultation time under your belt. And of course, don't believe everything you hear or read, even from your friends, whether it's the internet, but for your friends, even if they're your friends that are in the same state or the same city, their divorce is not your divorce. Tell them that you appreciate their advice, but that you need to focus on your situation and have them send you some Chinese food instead. Don't don't necessarily take all of their advice. Take the advice of the professionals that are going to help you with your specific situation. Be prepared. Gather all the documents that you can. Make a list before you go to see any of those professionals.
That is wonderful advice. And I want to thank you all so much for being here with us today. Donna Lascala, Lori Eichen, and Pam Friedman. I am going to list all of their contact information below. And be sure to check out Pam's new book, Financially Fit Divorce, which you can find on Amazon. If you're listening and you want to learn more about Certified Divorce Financial Analysis, or you want to find a CDFA professional in your state, you can visit www.institutedfa.com and you can search and find a CDFA in your area who can help you. We will also include a link below for anyone who would like to submit questions for a future episode of the CDFA Hotline. And I certainly hope that you ladies will come back and that we can do this again.
Absolutely.
Thanks
Thank
for having
you
me.
so much.